Infinite banking isn't about investing in life insurance. As a matter of fact, anybody that tells you that you are investing has no idea what they're talking about. Infinite banking is simply about you utilizing a tool and getting the most out of it. My name is Sean King, infinite banking practitioner, and in this video, I'm going to break down infinite banking for you at a 5th grade level. But before I jump in, I'm going to ask that you smash that subscribe button so you can stay up to date with all of the valuable information that I'm hopefully helping you understand on a higher level. And if you get any value from this video, do me a favor, hit that like button because that significantly helps the channel grow. Now, let's jump into the content. So at its core, when I talk about infinite banking, I just want you to think about it as a financial strategy. Some other financial strategies that you may have heard of are the debt snowball, which is essentially a debt elimination strategy. Another debt payoff strategy is the debt avalanche. Again, these are just specific strategies to help someone tackle debt. So when thinking about infinite banking, all I want you to do is think about it as a strategy on how to leverage the cash that grows inside of a whole life insurance policy. Infinite banking and whole life insurance are completely separate. They're not intertwined. A whole life policy is a life insurance contract, and infinite banking is a specific strategy that allows you to utilize the insurance policy to leverage it and treat it like a banking system. Okay, so now that we're all on the same page, I want to make sure that you understand that you can use this system to create financial independence by changing who controls the banking function in your life. What I teach and preach all the time on this channel is giving yourself the opportunity to have more control and ownership when it comes to the need to borrow money. You see, you'll never hear a wealthy person say that they got rich because they bought life insurance. They've gotten wealthy because they've used different tools to create wealth. A properly structured whole life insurance policy just happens to be one of those tools, but it will not make you rich. The idea is that you have to leverage the cash value that you build up in your policy and invest it in other cash flowing assets. That's how you build wealth. It doesn't work the other way around where you invest in life insurance and look at that, now you're wealthy. So you might be new to this channel and you might not be exactly familiar with what whole life insurance is or what cash value is for that matter. So let me break it down for you really quickly. Whole life insurance is a permanent life insurance product, which means that it's going to be with you for your entire life. That's a huge benefit because you don't have to worry about renewing your coverage every time the contract ends like you would with term. It also stays the same price throughout your entire life. Now let's talk about the cash value that's available inside your properly structured whole life policy. Okay, so the first thing that you need to understand is you're going to be paying a premium. Whether that's monthly, quarterly, semi-annually, or annually, you get to choose, but that premium stays the same. When you pay that premium, which is a number that you've decided on, you receive a death benefit. The life insurance company is now on the hook for paying out this much larger sum of money that you just purchased with your small amount. You see, if you pay, they're contractually required to pay as well. So when you pay your premium and that death benefit shows up, guess what else happens? A portion of that already paid for death benefit becomes available in the form of what we like to call cash value. You see, this is very important to understand. Cash value is simply the paid for or paid up portion of the death benefit that you're entitled to. The insurance company says because you've already paid for it, we're going to give you the ability to access that paid for portion and leverage it right now, however you so choose. Think about it like the equity in a house. You have access to a certain portion of the home's value. Usually with a home, that amount increases every year, but with your policy, it's guaranteed to increase every year. A lot of people confuse this process by thinking that they've just invested money into their whole life insurance product. And that's not the case. All you've done was you've paid premium and purchased a much larger guaranteed death benefit. You see, as soon as you do that, some of the future death benefit your beneficiary is guaranteed to receive becomes available for you to access right away, tax-free. This is not an investment of any kind, you guys. This is a perk of having whole life insurance. I just want to make sure that we're clear about that. Now, it's important to note that the money inside of your policy, that total premium that you pay each year, is going to compound uninterrupted within your policy for the rest of your life. There's one major difference that I want to point out between a regular off-the-shelf whole life policy that you might get from Jake over at State Farm and a properly structured policy built for infinite banking. Now, the policy that you get from State Farm is going to focus specifically on death benefit, meaning all the premium you pay will be going to purchase that death benefit. That's not a bad thing, but it does mean that your policy won't have any accessible cash value in it for at least the first 3 to 4 years, possibly longer. As I'm sure you can imagine, that's not what we're looking to create when building a policy for infinite banking purposes. That's why it's important to work with a certified infinite banking practitioner so you get exactly what you want. If you're wondering, well, how do I find one of those? You can just head on over to this website and select Find a Practitioner. My name will be on the list under the state of Florida, so you can rest easy knowing that I at least have some idea what I'm talking about. Okay, so like I was saying, off-the-shelf whole life focuses utilizing 100% of the premium to pay for the death benefit, providing you with no access to cash value early on. A properly structured policy is going to take your full premium you're paying and split it up. Let's use a 40-60 split for this example. That means that 40% of the premium that you're paying is going to purchase life insurance and 60% is going towards what the insurance companies call paid up additions rider. I can already tell that you're smart enough to know that if only 40% of the money is going to pay for death benefit versus the 100% previously mentioned, that most likely means my death benefit is going to be much lower. And that's correct. The focus when it comes to building a policy utilized for infinite banking is going to be on the addition of a PUA rider, like I mentioned before. That rider allows us to take a portion of the cash that we're putting into the policy, buy a very small amount of death benefit with it, and make the majority of it, I'm talking like 90+%, available to access via a loan right away. So instead of waiting 3 to 5 years for the policy to build up cash value that we can actually use, we've allotted less of the total premium amount to the death benefit and took the extra and put it into this rider right now that allows us access to cash tax-free within the first 30 days of our policy being active. What's really cool about this cash value that you're able to access and leverage from the policy is that it can be used for literally anything. Now, that's not the case for all loans. If you were to get a loan from a bank, in most cases, you'd have to use that money for something very specific. I'm talking like a business loan, be it a personal loan, maybe it's a mortgage. When it comes to the loan from your whole life insurance policy, though, you have options and control to do with it as you please. You can decide if you want to pay off debt with it, go on a vacation, buy a car, or invest to build passive income. It's completely up to you. The next point I want to touch on is the tax advantages. I want you guys to understand that all of the dollars that go into your policy as premium payments or additional payments like extra PUA all essentially go into one ever-increasing bucket that you are earning uninterrupted compounding interest on. The only way for you to interrupt that compounding is by taking a withdrawal from your policy. As a policy owner, you have multiple ways to access the cash within your policy. The two most common ones are withdrawal and a loan. When you withdraw money from your policy, you're actually pulling the dollars out of the contract. Those dollars can never go back into the policy and they'll permanently decrease your overall death benefit. We do not suggest taking withdrawals until much later in life. The second and most common way to access the cash is via a policy loan. What that means is you're actually leveraging a portion of your future death benefit and pulling that cash out through a loan. The reason that the life insurance company allows you to do this is because they already contractually owe you that money. Now, this is probably obvious, but you can only get access to the amount of capital that's been built up in the cash value, but there is no limit on how much of your accessible amount you can actually use. Now, normally the insurance company would be taking the money that they're loaning to you tax-free and using it to build their portfolio so they can be certain that they'll have the required amount of funds to pay out your death benefit upon your graduation. But because you're a policy owner at a mutual company, that means that you contractually get the first dibs at leveraging the cash value in your policy through a loan. Now remember, because you'd be using the insurance company's money, not your money, there is a small cost to accessing those funds because the insurance company needs to make sure that they're making the necessary amount of money to cover your future death benefit. So instead of withdrawing your money and interrupting the compounding, you leverage the loan through the insurance company and get access to their cash tax-free and pay something like 5% simple interest for the policy year. If you want to find out more details about this process and how it works, I'll link my full overview somewhere here right above. Another amazing benefit often overlooked when it comes to these policies is the fact that your policy's cash value is protected from creditors, lawsuits, and liens, which means it gives you an extra layer of security, allowing you to go about your day running your business or your life without the worry of someone trying to, essentially take what's rightfully yours. Honestly, you guys, there are so many benefits that I could talk about when it comes to properly structured whole life, but the last one that I want to mention here on this video is legacy planning. Remember, at the end of the day, what is the vehicle that we're looking to leverage? It's a life insurance policy. That means when you finally graduate, you're able to pass on that death benefit to your loved ones, and they can use it for estate planning. They can use it to continue to grow wealth for the next generation. They can use it for countless things. And the best part is it's all paid out tax-free. One of the most important things I want to bring your attention to is when that time does come for the insurance company to pay out your death benefit, it's extremely important that your loved ones, the people receiving the money, have been educated in a way that they know what to do with the money to continue to build and expand the family wealth like the Rockefellers did, instead of that money being blown in a generation or two like it was with the Vanderbilt family. That's where the proper coaching and teaching comes into play, and that's something we as coaches and teachers of this concept here at the Cash Compound help provide you with. Because it's not just about your life, it's about your legacy and the lessons that you leave behind. Now, you may be asking, Sean, this sounds awesome. How do I get something like this started? Like I mentioned before, you want to make sure that you're working with a certified infinite banking coach. If you so choose to work with me, I want to make a few things clear. Number one, I require you to watch our 45-minute overview, which is going to give you a much stronger understanding of the concept along with some real life examples. I'll link that at the end. And number two, I'm going to require you to purchase and read this 92-page book, Becoming Your Own Banker. Don't worry, there's only about 60 pages of actual readable content, so it's a real quick read, but it's extremely impactful. If you want to book a call, one of those two things must be done first, so we can have a high-level conversation about what it is that you'd even like to accomplish. I'll drop my link in the description below, so you can book that if you want to connect. I think this goes without mentioning, but I'm going to mention it anyway. Be sure to work with somebody who actually practices infinite banking in their own lives. Between my wife, my son, and I, we currently own 5 policies, not including the one on my father and the 3 on my sister and her 2 kids. It's truly a family affair over here, and we've used our policies for everything from debt payoff to vacations around the world to short and long-term investments. So find somebody that practices what they preach. This isn't about getting some cookie cutter policy that isn't even built for you. It's about understanding your specific needs and goals, whether that start with paying off debt. Maybe you're focused on getting your money into something safer that provides you with more benefits. Or maybe you're ready to get into investing and start building out your passive income streams. Each policy is going to be specifically designed with your goals in mind. Now, once you find the practitioner that you want to work with, the next step is to actually submit an application and to enter into the underwriting process. The insurance company is going to want to make sure that you're healthy enough to offer coverage, of course. If you've had some health problems in the past or you're currently dealing with something right now, don't worry. We can always put the policy on a spouse or a child and have you own it and control it as if you were the one that was insured. So if you have health concerns, don't worry. There's almost always a way around that. Once your policy is approved and your premium is paid, we'll help you set up your policy portal, and in a few short days, you'll have access to the cash value in your policy. At this point, you can make the decision to take the cash out and pay off debt or invest it, whatever you'd like to do. Or if you're not quite ready for that, you can simply continue stacking cash in your policy, allowing it to grow. Remember, there are 4 different ways to fund your policy, and they'll all affect the amount of cash that you have access to once the policy is actually in force. Number 1 is monthly. This is going to give you the least amount of access to cash because you're breaking up the payments over a 12-month period. Now, a lot of people do start with monthly, but if possible, we advise you start with another payment term or change your payment terms after the first year. Number 2 is quarterly, basically meaning that you'll pay your premium every 3 months. You'll have slightly more access to cash with this. Number 3 is semi-annually, which means you'll pay every 6 months. And number 4 is annually. We consider this to be the most effective and efficient way to pay because it allows you to get access to the largest amount of cash value possible as soon as possible. Let's say you start a $10,000 a year policy and you're paying annually. Depending on your policy design, you could end up having anywhere between $5,000 and $7,000 available to use when your policy becomes active. The more frequently you pay your premium, say every month, the lower that starting access to cash value will actually be. Now, let's run through some common mistakes to avoid when getting into infinite banking. I would say the first one is underfunding your policy. What I mean by this is the additional cash you're putting into your policy, aka the PUA, is completely optional. That means it's not required to be put in, but just because it's not required doesn't mean you shouldn't try to put as much in as they will allow you to. It's okay to flex that PUA payment down sometimes. I get life happens. Constantly paying less than what you stated, though, is going to call for your illustration to look nothing like it was originally projected to. The next point is not understanding how the policy actually works. Again, these are things that I've already talked about in the video, but it's important to treat your banking system like you would a business. It's about you taking ownership, taking the time to understand the terms and the conditions, and then applying them to your specific policy and understanding how they may or may not affect you. The third point, again, is making sure that you work with someone who is not only implementing this in their own lives, but is also capable of teaching you how to do so in your life. It's not that hard to work up and write one of these policies. The hard part is continuing to get educated around how you actually become the banker. So if you don't have consistent and open lines of communication with the person who's helping you set up the policy before and after they write it, and definitely after they get the commission, I'd highly suggest looking for someone else to work with. The last thing that we want to happen is for you to get sold a policy and never hear from your agent again. If that's the case, then I'm sorry, but you're not practicing infinite banking. You just have an expensive ass whole life policy. Remember, the policy is the product. Infinite banking is the process. Financial empowerment starts with knowledge, so do yourself a favor and just keep learning. Keep taking the steps towards securing your financial future. If my wife and I didn't take the steps needed to continue securing our financial future, we wouldn't have learned about this concept, and we would probably still be stuck trying to figure out how to pay off all of our debt and nowhere close to focusing on building actual real generational wealth. But because we took the time to learn about the process of infinite banking and getting the right style of policy in place, we went from $60K in high interest debt to almost $70K in passive income a year. The best way to reach whatever goal it is that you're going after is to start. The first step is often the hardest, you guys, but with a proper plan and coaching from people who have actually done it, it gets way easier. If you want to learn more about infinite banking, be sure to check out my full overview right here. And when you're ready to chat, click the link in the description or visit my website listed below and book yourself a call. If you found this video helpful, please smash that like button. Like I said before, it really helps the channel grow. As always, guys, the information is free, but the knowledge is priceless. I'll catch y'all in the next one.